Welcome to the deep dive. Today, we're jumping into Academy Sports plus Outdoors Q2 results. A really interesting quarter. Sales looked good, growth returned, but earnings per share, a bit of a miss. So let's unpack this. Academy just dropped their Q2 Fiscal 2025 numbers, and yeah, there are some key things to look at. Net sales hit $1.6 billion.
Which is up about 3.3% from last year.
Exactly. And maybe the bigger headline comparable sales, same store sales essentially, they edged up 0.2%. Now that sounds tiny, but it's actually their first positive quarterly comp since way back in 2021.
That is significant, a turning point potentially.
It really could be. And their online side, e-commerce, was booming up almost 18%. But then, like I said, profitability. GAAP EPS was $1.85, and the adjusted EPS figure came in at $1.94.
Yeah, and that adjusted EPS, the $1.94, that's where the kind of disconnect happens, isn't it?
Yeah.
Because analysts were expecting something more like $2.16. So that's a negative surprise of over 10%.
Yeah.
And it really creates this paradox. Sales look pretty decent, even meeting expectations, but the bottom line didn't quite follow through. So the big question becomes, how did the market react to that mix?
Well, the initial reaction wasn't great for the stock price. It dropped nearly 7% in pre-market trading right after the announcement.
Yeah, that reflects those investor concerns, even with the sales growth.
Yeah.
Profitability matters.
Definitely. But looking beyond just Q2, they also tweaked their guidance for the full fiscal year. They sort of tightened up the sales forecast. Originally, they projected maybe down as much as 4%. Now the range is between down 3% and possibly up 1%.
Okay, so narrowing the potential downside a bit.
Yeah, and the adjusted EPS guidance for the year is now pegged between $5.60 and $6.30. So still a mixed picture overall, but maybe leaning slightly more positive on the sales outlook.
And it ties back to what the CEO, Steve Lawrence, was saying. He pointed to that positive comp number as evidence of steady improvements in the business and progress on their strategy. He specifically said customers are, quote, gravitating to our diversified assortment and our value proposition is resonating. Getting back to positive comps after that long stretch, well, that suggests something fundamental might be shifting.
It suggests the strategy is maybe starting to work, not just a blip.
Exactly. It feels like more than just a fleeting good quarter on the sales side, even with that EPS miss causing some waves. It's like a green shoot, as they sometimes say.
Okay, so steady improvements, value proposition resonating. Let's dig into the actual operations. What's happening under the hood with margins and costs that might explain this dynamic?
Well, if you look at the gross margin, it was basically flat compared to last year, right around 36%. But underneath that, the actual merchandise margin, the profit on the stuff they sell, that actually went up by about 40 basis points.
Oh, interesting. So they made more profit on the goods themselves.
They did, which is good news. But that gain got wiped out by other things. Headwinds like, well, shrink, that's theft and damage, and also higher costs for shipping all those e-commerce orders.
Ah, okay. So better product margin, but higher costs elsewhere eating it up.
Precisely. And then you have SG&A, their operating expenses. Those increased by about 1.5 percentage points as a share of sales.
And what drove that increase?
Mostly strategic choices. About 1.3 percentage points of that rise was directly tied to investing in opening new stores. And another 0.2 percentage points went into tech upgrades.
So they're spending money to grow and get more efficient. It's an investment, not just runaway costs.
Exactly. It's that classic retail balancing act, invest now for future growth, even if it puts a little pressure on the bottom line today.
Makes sense. And speaking of new stores, they are definitely pushing ahead there. They opened 3 more in Q2, Florida, Virginia, West Virginia. That brings them up to 306 stores now.
And the plan is still 20 to 25 new ones for the whole fiscal year.
That's the plan. And here's a really key detail. The stores they opened in 2022 and 2023, which are now old enough to be in their comparable sales numbers, they're actually comping positive mid-single digits.
Okay, so those newer stores are performing well. That's crucial. It shows the investment in expansion is starting to generate good returns.
Yeah.
Typically, mid-single digits means, what, 4 to 6% growth?
Yeah, somewhere in that ballpark. It suggests the new store model is working and contributing positively, not just adding square footage.
And beyond just store counts, the data on who is shopping there is pretty fascinating. They cited Placer.ai traffic data showing really strong double-digit growth in foot traffic.
Okay.
And crucially, they gained share among customers in the top 2 income groups, households making over $100K a year.
Interesting. So attracting wealthier shoppers.
Seems like it. Traffic share was about flat for middle-income folks, say 50K to 100K.
Yeah.
And while they still saw some decline among lower-income shoppers under 50K, the rate of that decline slowed down compared to Q1.
Hmm.
Plus, they mentioned using Circana data to show market share gains in key areas like apparel, footwear, sporting goods, and even outdoor cooking.
So it sounds like they're successfully bringing in more higher income customers, but that raises a big question. Academy's brand is often seen as value focused. How do they attract those higher earners without losing their grip on their traditional, maybe more price sensitive core customer? That's a tricky line to walk.
Yeah, it really is. And it looks like their digital efforts and bringing key brands are major parts of that strategy. E-commerce grew 18%, as you said, and it's becoming a bigger piece of the pie.
Right.
They talked about a back-to-basics approach online, making the website easier to use, offering more ways to get your order, like pick up in store, and expanding that endless aisle so you can find more stuff online than maybe is in your local store.
Making it more convenient, basically.
Definitely. And then there's the brand power piece. They launched Jordan Brand,
Yeah.
obviously huge, in about 145 stores and online.
Wow, Jordan, that's a big get.
It is. They expect it to be a top 20 brand for them by year-end. And Nike, which is already their #1 brand, saw expanded assortments too. That kind of brand heat likely appeals to those higher-income shoppers. And they're backing it up with tech. They rolled out RFID scanners, which they said improved inventory accuracy by 20% and cut down on out-of-stocks, significantly boosting in-stock rates by 400 to 500 basis points.
That's huge. 4 or 5% better chance the item you want is actually there. That saves sales.
Absolutely. Better inventory means fewer lost sales, happier customers. It all fits together, better online experience, hotter brands, better stock levels. It allows them to appeal more broadly.
So we've covered their internal moves, customer shifts.
Yeah.
But what about the big external stuff? Tariffs are always looming. The economy is still a bit uncertain for many consumers. How are those factors playing into this?
Right. That's always the context.
Yeah.
And here, Academy made a pretty bold statement. They said they believe they've mostly offset the impact of the current incremental tariffs for this fiscal year.
Mostly offset. That sounds ambitious, given what other retailers are saying.
It is. Their CFO, Carl Ford, mentioned having additional visibility now and feeling well-positioned to mitigate the tariff impacts. It's definitely a stronger stance than many of their competitors are taking, who are often talking about feeling the pressure.
Okay, so how are they claiming to pull that off? What specific things are they doing to dodge the tariff bullet, so to speak?
Well, it sounds like a mix of things. They're working with their suppliers, the factories, and vendors to kind of share the cost increase.
Okay, negotiating.
Yeah. They're also shifting production to different countries where possible to avoid specific tariffs, adjusting how many units they order. And they did some proactive buying, pulling in extra inventory, especially on core stuff like bikes and weights, securing it at pre-tariff prices.
Smart, building a buffer.
Exactly. And finally, they're using pricing tools to carefully increase average prices, the average unit retail or AUR, where they think the market can bear it, to help cover those costs.
Right, passing some of it on. So AURs were up a bit in Q2, low to mid single digits.
That's what they said. But they expect that to accelerate in the second half of the year. Maybe high single digits, potentially even double digits across the whole industry, not just for them.
Whoa, double-digit price increases. That brings us back to the consumer reaction, doesn't it? Especially for those lower-income shoppers already feeling squeezed. How are people going to respond to potentially much higher prices?
Yeah, that's the tightrope. And Academy acknowledged it's not uniform. Some categories, maybe essential gear, people will pay the higher price, demand is inelastic. But in other areas, raise prices too much, and people might just stop buying or look for cheaper alternatives, demand erosion.
So it depends on the product.
It does, which is why having that diverse range of products and price points, that value proposition they mentioned, becomes even more critical. They need options for everyone.
Okay, so given all this, the Q2 mix, the strategic moves, handling tariffs, what's the big picture view for the rest of the year and beyond? Are those green shoots the CFO mentioned really pointing towards sustained growth?
Well, the CFO, Carl Ford, certainly sounded confident. He said, we're seeing the green shoots we saw in Q1 are accelerating. So he sees the positive momentum building, not fading.
Okay.
And it's interesting. An independent analysis from Investing Pro gave Academy a good overall financial health score, pretty solid. They noted strong profitability and price momentum metrics. And their model even suggested the stock may be undervalued. So external views seem to see some underlying strength too, despite the Q2 EPS wobble.
That's encouraging context. And operationally, they're sticking with that full-year comparable sales guidance, that -3% to +1% range. They keep talking about their balanced and disciplined approach to capital.
Right, meaning how they spend their money.
Exactly. They want to keep the balance sheet healthy, fund those key priorities like the 2025 new stores this year, keep investing in e-commerce and tech, and they're returning cash to shareholders. They raised the dividend for the third year straight.
Although they did pull back a bit on share buybacks in Q2, right?
They did, yeah.
Yeah.
Mentioned they prioritized using that capital for inventory, partly to manage those tariff impacts and support sales. So it's all about balancing those different demands on their cash.
And that commitment to the long game, investing in stores, tech, brands, even when the market reacts sharply to a quarterly EPS number, that seems to be the core message here. They seem focused on building for the future.
Yeah.
They end with a strong quote, saying they believe they'll come out of this year better positioned than ever to serve our customers and drive long-term growth. That's aiming high.
It certainly is. So, wrapping this a deep dive up, it's clear Academy Sports Plus Outdoors is in the middle of a complex navigation. You've got strategic successes like the return to comp growth and e-commerce gains, but also those ongoing economic pressures and the need to manage profitability carefully. It's a story of adaptation.
Absolutely. So thinking about everything we've discussed, what really jumps out to you as they keep trying to broaden their appeal and manage these external forces like tariffs? How do you see their approach potentially influencing the wider sporting goods market?
That's a great question. It leaves me thinking about this challenge. We live in a time where consumer incomes seem increasingly divided. Can a retailer like Academy successfully court those higher income shoppers with premium offerings like Jordan while still holding on to its traditional base that absolutely relies on that value proposition? Pulling off that expansion without alienating anyone? That's the tightrope walk many retailers face today, and Academy's journey is definitely one to watch.